Great. I'd like to thank everybody for joining us today. We have a nice large crowd. I'm Zach Miller. I publish tradestreaming.com, and my property, I guess, more in line with the discussion here, is newrulesofinvesting.com. The backstory here is that I work with a lot of advisors, a lot of people who are trying to break into the financial world, become sort of financial celebrities, and they ask me about writing a book. And instead of doing my own seminar, which I've done a few times, I decided to go to who I believe is a financial celebrity, and that's Mebane Faber. I know he doesn't use terms like that to describe himself, but and I just heard myself saying over and over again, hey, if you want to see like how to build a nice financial presence online, take a page out of the Meb Faber playbook. So I invited Meb to do the webinar tonight, which we're calling the Mebinar. I know it's not the typical conversation that he likes to have. He likes to talk about tactical asset allocation and shareholder yield. But more than anything, I wanted Meb to address sort of his process, how he's built his own expertise in his field, how he's published books, how he's used those books and leveraged those books to create other financial products. So I'm really glad that Meb is joining us today. I'll let Meb introduce himself in just a second. The meeting burner panel that you see in front of you, the software that you're using to dial into this call, you can ask a question. There's an Ask a Question button. We will have a Q&A section at the end. So if you do have a question for Meb, submit that through that, and I'll make sure that Meb gets asked the question as well. So let me turn it over to Meb to do a quick intro of who he is and why we brought him here today. Meb?
Hey, great. Thanks for having me. It's like you said, the moniker of celebrity. That's an interesting adjective to use when you're in the quant finance world. So whatever, I'll take it as a compliment. But yeah, we started a money management company in Los Angeles in 2006, quant based, and with a lot of different strategies, but we started out doing individual accounts and have 2 private hedge funds, and then we started kind of thinking about ideas and brainstorming about public-private products, and had a lot of reservations about mutual funds over the years, and then eventually kind of came to the conclusion that ETFs were it's what we thought a superior product to bring to market. We launched the first one in 2010.
Hey, Meb, I'm sorry to cut you off, Meb. You're coming through very, very choppy. That's what we're hearing from the audience.
Okay. If this is bad, I can call back into my cell, but it's totally clear on my end, so you can
okay. It's just coming through sort of like vibrations.
Okay. Well, you tell me.
And do you have background noise, like an air conditioner or a fan or something?
Nothing here. It's clear as day here.
There's some type of static on the line.
Okay. Well, if you want me to call in from a separate line, I'm happy to.
Yeah, I think you should try calling in
again.
Okay.
I'm going to hang up and give me 1 minute.
Okay, I appreciate it. Thank you. Sorry, everybody. That was Meb. We'll just pause. His phone line wasn't very clear, so he's going to call back in. We'll just wait for him here.
Hey, this is Meb.
I can introduce my. Is that Meb?
Yep. Is this better?
Much better. Much better. So, can I ask you to start over?
Sure. Well, it goes to show this day and age when a cell phone has better reception than a landline. Yeah. So we started a money management business back in 2006. Started managing money in 2007, quant based. We've done separate accounts, 2 private hedge funds. Launched our first ETF, partnered with another party in 2010. Launched our own suite of ETFs starting this spring with shareholder yield in May. And the goal is to get out 5 to 10 quant-based ETFs in the next few years, and under this banner of actively managed strategies, but targeting index-like fees. And I can talk a little more about the publishing, but I imagine we're going to get much more detailed into that, so I will hold off on the research side for now.
Okay, great. So I'll just tell you a little bit about myself. I see a lot of people I know on who have dialed in already. A lot of you I don't know. I'm basically the big schluff compared to the other guy on the line. I've done my own stuff, sort of finding my own way in the finance space. I'm currently a partner at Our Crowd, which is one of the largest equity crowdfunding platforms in the world. We invest in Israeli startups, but most of our investor base is based in the U.S. We've raised over $23 million so far in the first 9 months for our startup portfolio. I've also worked and consulted with many of the top VC-backed sort of next-generation financial sites like Seeking Alpha, Covestor, Lending Club. I work with small RIAs as well to help them essentially to bring in new business and to build their investor base. I published my own book in 2010 called TradeStream Your Way to Profits, and I work a lot with in the financial space to help people sort of get online and understand how to use social media to build a modern financial practice. So that's how Meb and I have connected over the years, and I'm glad that Meb is joining us. So Meb, let's just start, and we'll get right into start talking about your first book.
So, publishing for us was always somewhat of a, in the beginning days, was somewhat of a reluctant kind of task. And it's kind of an interesting story. I being a quant and being secretive and having, proprietary models in-house was kind of the way most quants sort of do things. And so I had was sitting for a designation, which is called the Charter Market Technician, which is kind of like a CFA, but for technical folks. And it's a 3-year program. And the third year, you had the option of taking a test or writing a paper. And the last thing I ever wanted to do was take the test. I had a lot of material on there I didn't really believe in. There's certain types of quant and technical analysis that I think is, more akin to astrology. And so they announced they were getting rid of the paper. And it was around November or December, and they said they're done by the end of the year. So I just submitted an abstract. First thing I'd really ever written, but I was like, I have to write something so that I can avoid taking this test. And that was really the genesis of starting to write about finance and investing, and it became a white paper that eventually, and we just put it up, we published in the Journal of Wealth Management, put it up online for free, and it became pretty popular, largely because it was written in a way I think that resonated with people, that a lot of academic papers are so obtuse you can't even get through them without your eyes glazing over and falling asleep. But we tried to do it in a way that was consumable by most investors, and that paper became very popular for some of those reasons. And at about the same time started writing a blog. And I was seeing the other day that Abnormal Returns is just reached their 8th blog anniversary, which was one of my favorite writers out there, taught us. And so anyone that's been writing as long as kind of we have, you're almost like the grandfathers in the blogging world. So it started way back in, it must have been around 2006. And so kind of reluctantly, but being a quant, you don't, like many fundamental analyst friends of mine, you're not interacting and talking to people all day and going to conferences and meeting with CEOs and all the things that those sort of analysts do, and it's much more solitary. So I was trying to write in a way to be able to get my work out there, but also interact with other people and get them to review it, write back. A lot of ways to improve our internal research as well. And so the blog and the white paper actually led to the book, and really had no intention of ever writing a book. And it was something that we had brainstormed for a while and said, maybe it sounds like a massive effort. But eventually Wiley, who's, one of the major publishers in the finance space, came to us and said, have you ever thought about doing one? We'd like to work with you. And that was really the genesis of putting the first one out.
Is that pretty common nowadays that the publishers are seeking out sort of top thought leaders online?
Well, they do, and I have a couple buddies that are in the writing agent space or editors, and we didn't have one. But when you find someone that maybe has a good story or is writing about something, they tend to seek those people out and say, hey, they're essentially looking for ways to, monetize a new person or idea. And so, we said, okay, maybe we'll do this. In my head, it seemed like a kind of monumental task. And we eventually agreed to do it with Wiley. And for the longest time, I couldn't start the book. It just seemed like too much work, too much effort. So months went by where I just had essentially writer's block, couldn't start it. But once it initially started flowing, the book only took a couple months to write, and the much longer.
Why? Because basically you had worked a lot of the content out on your blog?
Yeah, and so one of the benefits of writing a blog or just writing in general, whether it's a diary or internal research, is you have something to work from. Starting from a blank piece of paper is the hardest thing on the planet. And so to any aspiring writers or people thinking about writing a book, the best advice I can give is, just start writing. It doesn't matter if you publish it. It doesn't matter if you do it on a blog, but just start writing so you have some material. And so, for example, we've done, I think it's over 1,400 articles on the blog now, and so it's a pretty big repository of some of the ideas, and it's kind of like an online diary, right? In many ways, what you're thinking about, and I'm just typing up one right now, or was before this call, about some of the ideas that we saw out in the ether in the last few days. And that makes it a lot easier. And so once you have the material, so for example, when we did the book, we were able to draw from the white paper, which made, the actual writing process much, much easier.
Interesting. So did you get any data? I know you were looking for, before, about how well the book is sold. Yeah,
sure.
Just at least even a qualitative way.
Yeah, no, I'm one of the people that's kind of happy to be open, kimono, and fully transparent. If you look at kind of most of our work online, we have really no problem with that. I know a lot of people tend to be very secretive about, what they're up to. But yeah, so the first book, and so let me back up for a second and say a few things. A lot of people, most authors out there are authors, where they're trying to monetize the book from simply the sales standpoint. And in our field, it's often slightly different in that many of the money managers or researchers are using books or their research as a way to get their views out into the world and or maybe drive eyeballs to their work or to their funds or to their research, which has a much higher possible monetization than simply the book alone. Because book economics, it's very much a long tail. So the Harry Potters of the world and 50 Shades of Grey are going to be the books that make a ton of money, and then there's a very long tail of books that just, do okay or maybe profitable. So having understood that, we said, look, and I'm happy to make a few comments on the process of putting out the book, but we used to joke after we did the first one that the next book would be 100 things not to do when writing a book. So I can kind of give a few viewpoints on that, and I'm sure you can sympathize with some of them. But so the book sold, I think it's in the ballpark around 24,000 copies. The vast majority, so the way that it worked, it did hardcover, and then, a year later, paperback came out. And this was kind of before a lot of the ebook, world has exploded, so the ebook came out after. And one of the challenges also was that, Wiley had been a very good traditional publisher, and, some of the charts didn't necessarily translate into ebook, et cetera, et cetera. But 75% of the book sales to date have been physical books. Now, that metric is going to be very misleading because I've talked to a few buddies that have published numerous books over the last 5 years, and that percentage is not only equalizing but flipping, so that the number of ebooks has caught up with the number of total books and or exceeded that number, which is a very interesting kind of sea change in a very short amount of time.
Amazon itself is reflecting that in their sales as well. I think they're selling more ebooks now. Maybe 2 quarters ago was that inflection point.
Yeah.
So let's move into, so you started with, and by the way, 24,000 is a very successful number for a first-time author, right?
Yeah, and a couple of the things that people think about doing a first-time book, just a few comments on the process, and going in blind, it tends to be challenging. Most financial writers aren't going to get much, if any, of it in advance. But my argument has always been that you probably shouldn't be doing this for an advance. If you're trying to really make money off of the book, unless you're a Taleb who's going to get $1 million or someone like that. One of the challenges, and this will probably segue into why we self-publish the next book, some of the challenges of a book, and especially the first book. Now, I also wholeheartedly recommend first-time authors. I think it's great to publish with a big publisher for the first book. It gives you the impression of some legitimacy. For a lot of people, it's hard to understate the romance of being able to see your book in the airport or at a Barnes & Noble. You can send people hardcovers of the book. It's a great thing to have done, and it's going to be fairly professional. Now, there's some things, of course, some downsides too, namely that you lose control over parts of the process if you don't negotiate the end in. So, for example, the price point. Our book retailed, I think, at $50, which is much higher than I really wanted the book to be. And we negotiated some other aspects, such as I've always believed, and I think Wiley, I loved all the people I work with. They're great, but there's some and I would tell all of them this as well, and they would probably agree with me. I said, look, a lot of their finance covers are terrible, for example. So one of the things we often did was would hold design contests for the cover, for example, because you see a lot of their covers that come out, and they're just challenged to say the least. So we learned a lot, and one of the biggest things that I think is important from an author's standpoint is you need to realize that 90% of the marketing and sales of the book will be from you and your brand, and you taking charge of marketing the book or getting it into the right places or right people's hands. And you may even want to go as far as to hire some PR to do it, but would not expect the publisher to take over that role, again, unless you're a Taleb or someone with a already massive presence. So that was supposed to be the long-winded segue into, I think, the new one, but I can easily babble on this stuff forever. So feel free to cut me off if I'm too long-winded.
No. So can you tell us a little bit, at least, what the new book's about, and
Sure.
Sort of the bullet points here?
Sure. So shareholder yield is something we've been writing about for years, and we have a number of kind of these ideas. We've put out about, it's half a dozen or a dozen white papers in this sort of 10 to 40 or 50-page range. And one of the challenges with the white papers is I put them on SSRN, I put them on my site, but it doesn't have a lot of the distribution that an Amazon may have. And so I want a lot of my pieces that are meant for a broad audience, I want it to have as broad as exposure as possible. Now, shareholder yield was a book and a concept, and it's targeted at what we think is a much better way of income investing in dividend stocks. And the quick summary is that we think one of the most basic mistakes in investing is looking at stocks based on dividend yield alone. And one of the reasons is a structural change since the 1980s, where the SEC approved a rule that gave companies safe harbor from buying back their own stock. And you've seen, especially in the U.S., an explosion in buybacks as an alternative means of distributing cash flows back to investors. And in certain tax environments or regimes, it's much more efficient to do it, not currently since the new tax brackets passed, but who knows in the future. And then also, if you have a value bent and the stock's trading for less than intrinsic value, buybacks are actually a better use of that cash. So we kind of, the point of the book was to educate readers on that space. There hasn't really been a book that tackles the topic the way that we like it to. There's been a few that touch on it, a few academic papers. And so we did essentially a book, and it's not, I hesitate to even call it a book because it's only about, I think, if I remember correctly, 60 pages or something. But we wanted it to be on Amazon as a distribution method to be able to get it in people's hands, not just as a white paper. And so we kind of went with it, and we had talked with Wiley for a while about doing it, but it didn't make a whole lot of sense to me to go through them and give them all the economics and lose, most importantly, lose control over a lot of the timing. This is a big one if you're an author and you hand off a manuscript that may not come out for 3-6 months is more typical, or 8 months even. So after you've even finished writing a book and it's 100% done, it may not come out till up to a year later, which can be very frustrating for people when they have something, especially that's topical and timely, that may not come out for a while. So that's kind of the basis behind the book, and the quantitative research shows that when you sort portfolios based on shareholder yield rather than dividend yield, you come up with a much better portfolio, more balanced. It's cheaper, and then of course it outperforms. The broad shareholder yield does a much better job than dividend. And then if you know us at all, we sprinkle on a little momentum at the end, and that helps even more. So we think it's a much better approach, and that's kind of the quick 1-minute overview of why we ended up writing that book.
And you launched sort of a similar ETF that embodies the same sort of investment philosophy. Did that come before or after the book?
That's a great question. It came before the book, and the large reason why, the book had been written for almost a year before the ETF came out, but when we filed to get our exempted relief from the SEC, for an ETF, that takes often a year. And it's a really long time. It's super expensive. A lot of headaches to deal with just getting that. It actually took us 16 months. And so this was dragging on, and I wanted nothing to get in the way of this fund coming out. So even though there's a 0.001% chance the SEC or someone would get upset about us launching a book on the topic, we wanted to make sure that nothing would get in the way. So we actually waited and delayed publishing it until the ETF came out, which was in May, mainly because of that reason alone. We didn't want anything to interfere with the launch of the fund, which was to us much more important event than getting the book out there.
Interesting. So in your segue, you sort of talked about that move from being a first-time author with a mainstream publisher to self-publishing, and you talked about a few of the reasons why. Can you be succinct and tell us why you chose specifically with this book to bring it out on sort of under your own title?
Well, we said, all right, we took a step back and said, what's the goal with putting a book out there? A lot of people, get excited about writing a book and don't really have necessarily a plan, or they don't understand their fundamental reason why they're doing it. Most people see again, going back to the romance of just writing a book, which is great, by the way. Seeing it in a Barnes & Noble is a wonderful feeling. Being able to send it to your mom and, her get all excited about it, that's a wonderful thing to do. However, many of them, kind of also see the pot of gold. I'm going to make $10, $50, $100, $1 million, out of this book, but don't think about it long enough ahead of time of why am I doing this. And so in our case, it was, look, we just want as many people to read this piece as possible. That's it, number one goal. So making any money off this book was much lower down the list from the book itself. But, the goal was to raise awareness about the firm and about the ETF in general. And so I said, okay, well, in that case, let's price this. In my mind, we originally listed it on Amazon, iTunes, and Barnes & Noble. And we said, all right, we want to price it low enough to where people can buy it and as sort of an afterthought, but we didn't want to price it at $1 because we thought that people may think, hey, this it's kind of perception, but may think this book doesn't have much value because it's so cheap. So ironically, we priced it higher, but because of the sole reason of just perception of quality. But because the book was shorter, we didn't want to charge. Our first book was $50. This one is now $5. So we launched it on the 3 platforms and quickly came to notice, and this wasn't a surprise, but the vast majority of the sales were going through Amazon rather than Apple or Barnes & Noble. And Amazon, in their wisdom, has a program where if you only publish the book on Amazon and agree to be exclusive, any of their Prime members can download the book for free, and you still get paid on the book, which is an interesting program. I don't think we got a huge number that did that, but a fair amount. And then they have a second program where you can also designate a period of a week, I think it's 5 days per quarter if you want, to have the book be completely free. And so you don't get paid on it. So we said, okay, well, that's interesting. So we actually did that. So we kind of went through the process. The book was online. It was selling. We did a free period. And we also, I think I did a few promotions. I said, look, maybe on Twitter one day, I said, look, the first 50 or 100 people, if you want a book, I'll send it to you just for free. And so, it's interesting. And then I've seen a lot of self-published books by friends of ours, and the early days, they were pretty poor quality, the paperbacks. It looked like something that was self-published. And so we didn't want to do that, but then I said, okay, maybe I'll just order a proof and see what it looks like. And it showed up, and it actually looked great, and much to my surprise, many, many times better than I was expecting. And ours is, we did it in sort of a magazine-sized format, so a lot of the pictures are easier to read, and the text is much clearer. So the paperback, we priced at basically break even, so we make like 10 cents off of it, but it's $6 or whatever it may be, but just so people could buy it and get the book in the mail. And, a few interesting takeaways. So the book, and we weren't surprised by this, but surprised maybe in the magnitude. When we did the free promotion, obviously lots of people downloaded it, but it is something like 5 times as many people downloaded the book for free than bought the book within the first month or two of it being out there. And to us, that was a very surprising takeaway, but we loved it. I mean, I was very happy that many, many people downloaded the book for free, but, it just goes to show that there's that many people that said, you know what, I'll do this for free, but I'm not paying $5 for it. But for a distribution method and us getting it out there, it was wonderful to see. But surprised us in the sheer amount of people that were more interested in downloading it for free in that 5-day period than purchasing it online.
And again, your real purpose was to put it in as many hands as possible, right? So whether it's free or to pay for it,
Right. And so now there's some challenges. So the mainstream media still, I don't think, sees just an ebook, and people self-publishing necessarily as being as legitimate as a real book for who knows what reason, right? So what we would talk to people and say, yeah, we just put out a new book. We can send you our new book. And they said, yeah, here's our mailing address. And no, it's just an ebook. Let's send you the ebook. And you run into a few challenges. I mean, there's a small percentage of the population that doesn't read ebooks at all. And probably a lot of our target demographic investors don't read ebooks. And, you lose a little bit of probably the PR of being able to send someone a hardcover book, or getting some of the reviews, et cetera, online that people but now that there's trade-offs, of course, and one of them being we control the entire process. And an idea for the financial advisors or money managers on the call or people looking to sell a service, you could even use the book, for example, as a pure lead gen and say, hey, look, we will give you the book for free if you fill out a landing page on Unbounce or somewhere, and, we capture your information as a lead gen for our hedge fund or our investment management business, and we'll send you a free book. And the interesting part about that is if you do the mathematics, so the Amazon program, if you're $1 to $10 on the pricing point, you get 70% back. So at $10, if you sell the book, you get $7. Amazon keeps the rest. Well, the interesting part is if you give someone a book, if you gift it to them, it's not a $10 cost, it's a $3 cost. In our case, it's not $5 cost, it's $1.50. So financial advisors could think about that, and if you look at a lot of for example, the $60 billion Fisher investments online, a lot of these kind of masters at the landing pages and how they drive lead gen, a lot of that's done through the sort of landing pages and offering a free content, whether it's a white paper or book or whatnot, in exchange for getting contact information. So we haven't done much with that, but I think that's a untapped resource for a lot of authors and money managers.
That's great advice. As we talk, we're going to move into a section where we talk about more about the overall publishing process and why it matters. But there was a question that came through the crowd before we move on. It was specifically about the ETF and how do you target SYLD to be different from PKW, which I guess is the PowerShares buyback achievers.
Sure. Well, so the interesting thing about ETFs or about our area is, so we say, look, we think all the dividend funds are doing it wrong. And I'm actually writing a piece right now called the Dividend Challenge. It'll come out at some point in the next week or two based on FINRA. But a simple summary is, look, we think for the same reason that all the dividend funds are doing it wrong, all of the buyback funds are doing it wrong. You're ignoring half of how companies distribute their cash flows. So it makes, and a simple example, I give often when I give a talk is I say, all right, I'll go up to my 15-year-old niece and I'll say, I'll give you two choices. I'll give you a $20 bill, or I'll give you a $20 bill and a $20 Amazon gift card. Which do you want, A or B? And because she's such a bright girl, she says B, just like any rational person would. And my example is, if you're just looking at dividends or buybacks, you may see A. You may only see one side of the coin. And it literally makes no sense. Dividends and buybacks are the exact same thing from a finance 101 standpoint if you assume equal taxes and the stock trading at intrinsic value. So from a logic standpoint, it makes no reason to look at dividends or buybacks, and I could go on about this for hours. So looking at, say, PKW or the other buyback funds, they have the same error as do the dividend funds. However, there's a couple of comments to make on top of that. I think PKW only looks at gross buybacks. It's really important to look at buybacks net of stock issuance. You have a lot of companies out there that are buying back 4% of stock in one hand, but issuing 4% in options in the other hand, and that doesn't do any justice to the shareholder. They just end up with a net zero. Or you could even have a case where a company, say, is buying back 4%, issuing 8%, so they're actually diluting you even if you think you're getting 4%. PKW is also more expensive. We're at 0.59%. The reason why a lot of the buyback funds have been doing so well this year, shareholder yield included, is because dividend funds are really expensive. If you look at a lot of the dividend funds, as money is rushed into a lot of these high-yielding products and people are searching for yield, dividends, which have historically traded at a 20 to 40% discount to the overall market based on valuations, not only now are not equal to the market, they're more expensive. And that we're really, really cautious about dividends. We talk about this a lot to people. The highest dividend yield is one of the most dangerous places to be. You couple that with the fact that they do worse in rising rate environments, and you have this sort of double whammy right now. And one of the reasons dividends yielding funds have done poorly the last 4 months, and buybacks have been doing better, is that many of the buyback strategies are targeting lower valuation companies. And so it's very, very important that you have a valuation filter, which we use. We screen for the cheaper companies. Last thing you want is an expensive company buying back their stock. So you will see some overlap between our fund and the buyback funds, but you also see between our funds and the dividend funds. And so we kind of make the argument it makes really no sense to only be looking at one or the other when you really should be looking at both.
Great. So let's transition now from talking about your actual products to more of the bigger picture and how, and you've said this already, sort of how publishing and books and your content, getting that in the hands of your readers is complementary to what your day job is. But can you talk about sort of why publishing matters in the context of your business and I guess in finance in general?
In this day and age, people have a larger soapbox than ever before. And to the extent you want to get your views out, publishing, and this could be blog, this could be white papers, it could be books, enables you to have as big a megaphone as you want. Now, that is good and it's bad. if you write content that people want, that content that people think is useful, you can build a brand, you can build an audience, you can build a business around that. There's a lot of shortcuts, I think, to getting traffic. There's a lot of websites out there. We did a post years ago. It said the number one key to getting traffic on your blog, and the answer was simply how many times you post per day. And the more you post, the higher traffic you get. Simple reason people are coming back to your site more often. Doesn't mean your traffic is valuable. It doesn't mean that people are benefiting from it or becoming stickier to buy your products or what you may be selling, but it's a simple takeaway. Now, it's also dangerous because if you choose to get this huge megaphone and there's plenty of these kind of gurus or market celebrities that are out there making prognostications and forecasting things like, you know what, gold's going to 4,000 in the next year. The Fed's doing this, the Fed's doing that. Or the market's going to 500 or market's going to 5,000, whatever it may be. And you have this huge megaphone. In many cases, people do that, and since they're proven correct, it's a wonderful thing for them. But if you're also people, I've watched many do this on Twitter or on their blogs as well, can also make a fool of themselves, for the same reasons, acting childish, writing very poor content, and essentially destroying their brand. So it's can be used for good or bad, but it's simply a way of giving yourself a platform, and across a lot of different types of ways to distribute it.
Do you think publishing as time goes on becomes more important or less important?
We've had a different model than 99% of financial advisors and money managers. So the ETF companies we compete against, I'm friends with most of them, but often people say competition. They have 5, 10, 50, 100 wholesalers and marketers that are out selling, kind of like the traditional mutual fund model of selling their funds. And our model has been different. It's been more of a content and education piece where people find it and understand it and can get on board or not, rather than us selling it to someone. And it may be better or worse, but from a small company standpoint, we only have 4 people at our shop. It's the most efficient way of being able to get our views out in front of as many people as possible. And again, most of our models are quant, so again, they could look great, they could look terrible, and that's just part of the process. But it's for us by far been the best way and most, I think, genuine way. Last thing I want to be doing is out. One of the reasons we didn't do mutual funds, there's so much baggage involved. There's various load classes and front-end loads and sales fees, and someone's getting paid to sell it, and you, by the way, have to pay 0.4% just to be on Fidelity's platform. There's just so many conflicts of interest, which is one of the reasons we think also that this trickle that has been assets going to ETFs from mutual funds will become a flood at some point when people really wise up to the amount of fees and kind of conflict of interest involved in a lot of those funds. But for us, it's been a benefit more from the standpoint of just being a great platform for us to get our message out there.
So as we get to the sort of latter part of this presentation, I'm curious to know, are there things, and you mentioned these sort of earlier in the presentation, but are there things that you would have done differently, knowing what you know now?
There's a lot of things we would have done differently. One, and you talked to James Altucher, has done a number of good articles on this topic. He writes the Altucher Confidential, for those listening in, about publishing books. I mean, he's done about 8. And it's funny because after the first couple, every time I would talk to him, he says, I'm never publishing a book again. And then, of course, he goes and writes another one. He is, self-published 3 or 4, I think, at this point. And he probably offers a lot more kind of a lot of interesting takeaways on marketing and self-branding. He spends kind of a lot more time on it and more in depth. So you could probably send out a few of those links to your readers after this that would be useful. But a few of the things, the first book we wrote probably should have been 3 different books. we did a little bit of a kitchen sink approach where I had all these ideas and I wanted to cram in as many as possible for the people that hadn't heard about us. And there's the book actually, there was so much in it that it's some of the best ideas I think kind of fell through the wash on the book as a whole. I think, again, I went back and said I still think it's great to do a book with a traditional publisher, at least to get your feet wet on the first hand. But you need to realize a couple of things. The biggest one is you're going to be doing all the marketing, and so realize that ahead of time. A couple other ideas. We outsourced a lot of the work on our second book. So editing, for example, you should definitely hire some sort of editor. We used the website Kibin, Kibin, which is kind of crowdsourced editing. We would run it through 3 or 4 stages of editing for that book, which is a great resource. 99 Designs was a great resource for designing your cover. So I joke with a few of my friends that have finance book covers that they should certainly take charge of that. And you'll still find some errors in your book. It's like nails on a chalkboard for me, but it is what it is. So the world's, I think, changing quickly on some of these distribution models, and a lot of the publishers are still holding on to the old model, but most of the bargaining power and benefits are going to go to the content creators over time, which is a wonderful thing to happen, kind of getting rid of the middleman, because it benefits authors as well as the readers. But yeah, I would argue to try and outsource a lot of even the title. So for this past book, this was a Tim Ferriss idea, who writes 4-Hour Workweek, but we had a few ideas for the title, and I didn't know what people would like. I profess no marketing ability, so we held a contest online. Not a contest, sorry. We did that with the cover. We held a Google AdWords campaign where you can, set up 5 different titles. And we were doing this for the subtitle of the book. And the one that won was actually one that I would never use because it sounded too snake oily, but it was shareholder yield. If you're investing in dividends, you're doing it wrong. So like kind of but those are the things that get clicked on the most, because people, if you look a lot of headlines on a lot of blogs and news sites, they tend to be kind of these clickbaity, sensationalistic titles. But I would also argue to be wary a little bit of those, especially if you're a professional, because while you may get some benefits of traffic in the short term, or it can also be a takeaway or a detriment to your brand over time.
So sort of a similar question, just asked in a different way. To the next slide. Do you have any advice for people just starting out on this process?
If you're going to do a first-time one, yeah, read what a lot of authors have written. Again, going back to Altucher, we've done a handful of posts on our blog. Tim Ferriss has done a handful where authors kind of talk about what they would do differently, why they would use certain outlets, people to talk to. It gets you much more comfortable with the process. All of those for sure. And then, again, just reassess why you're doing it. That's the biggest one. Are you doing this just because you want to get a book out there? Or are you doing it to make money? Are you doing it to drive eyeballs to one of your products? And really kind of craft the book around that message. And then certainly get a lot of people to read it and pick out someone good for the dedication.
Great. So tell us about what you have in the hopper. You said your ultimate goal is to launch 10 ETFs. It sounded like. How does publishing play into sort of your future plans?
So here's a good example. So we filed for 4 ETFs in our first trust, and then the day before the government shut down, we filed for 4 more. So we got 8 in the queue. And if you want to go online, you can certainly look those up on the SEC database for any funds that have filed to be launched, but we have 8 out there. And the goal is to launch funds that I would put my own money into. So I have 100% of my money in our ETFs, and the reason being is that there's a lot of strategies. The beta landscape is mostly covered, and that is a low-fee game, which is great because Vanguard, State Street, and BlackRock are driving the cost down of these broad asset classes. And I heard Vanguard about a year ago give a talk that said most all the ETFs that need to be launched have been launched, and that just made me smile because we have plenty of good ideas that I think investors haven't had exposure to. And so one of the ones that we plan on launching is based on a paper we published a year ago that sorts countries around the world based on 10-year PE ratios, and it was based on some of the work that the new Nobel, Schiller, published in the 1990s, which was also based on work Benjamin Graham did about 70 years ago. But it's a simple value approach to picking countries. And so we wrote a paper, again, so a white paper about a year ago, published it in a journal, may transform that into a book. But a great example that I want to touch on is the perfect example of why you may need to marry content with a fund is that a lot of people launch funds and they kind of sit there at 2 or 5 million because they haven't really educated the marketplace on those funds. And one that we really want to launch that's, I think, a great idea and strategy is the Currency Strategies Fund. And the challenge with that, of course, is that most investors, especially Americans, aren't that familiar or comfortable with currencies and certainly don't see currencies as an asset class. And so they think about currencies as, hey, I'm going to Argentina, steaks will be cheap, or it's going to be expensive to go skiing in Switzerland this year. It's mostly a travel, or the dollar is going down, the Fed is destroying the dollar. But they don't think about currencies in the same way they think about it as equities or bonds. So, for example, PIMCO launched a Currency Strategies Fund, seeded it with $20 million. It's still sitting at $20 million, I think largely because of this reason where many investors just aren't comfortable. So that'd be a great example of it would benefit the fund and or the strategy to come up with a piece, white paper, book that kind of illustrates, hey, this is how you should be thinking about this. This is why you should be thinking about this strategy this way. And I think investors really appreciate that because they get comfortable with the process and comfortable with the fund. Last caveat to having these public funds, of course, is after they're in the water for a year or two, it becomes a performance story because investors love to chase performance. So whatever becomes hot, DXJ is a perfect example. That's the yen hedge Nikkei, Japanese stocks, sat there for years at 200 million, and starting about a year ago, went to 15 billion in under 6 months, largely because people were chasing this yen Nikkei trade. So we think it's really important to educate the investors in kind of what we're doing so they can make an informed judgment on, hey, this is a good idea or this is stupid or whatever it may be. A lot of these ETF providers, mutual funds are the same way, throw as much stuff against the wall just to see what sticks, and we think that's a much different approach. We'd much rather take a rifle approach on things we would like to see out there.
I think that's a great point. Not only does it help to harvest assets, but you're actually preparing the ground for the acceptance of particularly nuanced new securities. I think that's a great point. So I've asked you a few questions that have come through. We're getting to the Q&A section of the webinar. A couple questions came through that I haven't yet asked you, so I think we'll ask you those now. If you're in the audience and you have a question for Meb, please click the Ask a Question button. That question will be submitted to me, and I'll make sure Meb addresses it. The first one's sort of a technical question about publishing. Did Meb go exclusively with Amazon in the new book and therefore use CreateSpace, which is their publishing on demand system? If so, would you recommend this approach, or would you also look at some of the other alternatives like Smashwords or BookBaby to reach a wider audience?
And we touched briefly on this. One of the challenges, and one of the most shocking things to me, is that Amazon doesn't have a better software interface for uploading and publishing your content to Amazon. It's actually horrific. I mean, I would give it like a 2 out of 10. So unfortunately, you need to go create your file elsewhere. The website we used was Vook, V-O-O-K, which lets you generate a file that's you can publish on any platform, Amazon, Apple, Barnes & Noble, etc. So that's a great, and it's low cost. Their business model is evolving, but when we used it, it was low cost. Barnes & Noble, on the other hand, has a fantastic content uploader. I would expect that to change at some point, but the experience on Amazon was kind of shockingly bad. CreateSpace surprised me, in the quality of the book they sent to us. again, it's a process that if you're not that tech savvy or internet savvy, it may be painful. But if you're a normal web tech user and can operate email and even if you are familiar with WordPress, you should be able to get a book out on your own. That's pretty simple. Now, we didn't test the hardcover waters, nor did we. And I went through about 8 of those other sites that you mentioned, but the book to us, because we use WordPress, was the easiest.
Okay.
There's some other evolving models. I know some people are using BitTorrent and other ways to get their content out there, but we were happiest with just using a book into Amazon.
Sounds like you're a Tim Ferriss aficionado.
A lot of what he does, and he is kind of the ultimate marketer in the sense that's like all he does, and it's shameless in many ways about his brand. But he's
also quantitative, like in his approach. I guess that resonates with you, right?
Right. He's objective about it and smart about it. I would argue, just happen to be a little lazier about it. But he certainly is kind of extreme, but has come up with a number of ideas that I think are useful or reasonable in getting your work out there. The biggest takeaway is you can be still very professional and do everything on the up and up and never sacrifice any sort of quality. Never feel like you have to be snake oily in any way, and still apply some very intelligent type of marketing ideas. Unfortunately, in our space, you see kind of the opposite. You see a lot of the sleazy kind of marketing tactics go on, especially in finance and investing marketing. But the good news is you don't have to necessarily you don't have to do that to be able to be smart about your marketing approach.
Okay, we still have a couple more questions. I'll try to get everybody in and out within the hour. So quickly, which social outlets have been best referral mechanisms for you? Twitter, LinkedIn? What's working for best?
I have never used LinkedIn for anything really. I have a profile on there, and once a month I'll check on there just to accept connections. But I, for the life of me, have no idea how to use it. So I'm the wrong person to ask on that. Twitter has been kind of a pleasant distraction. Typically we have the blog that will auto-post our posts. Over time, it's become a little bit.
When you say auto-post, it's automated. It's automatically putting a link up on Twitter.
Right. It'll tweet a headline of a blog post we wrote. So the blog for sure, because the blog, it's great in the sense that we now have, and it takes time, but 1,400 posts that are essentially an encyclopedia or diary of the way we think, and people can get to there and read things that we've written for the past 6-7 years. That's the biggest one for me. And certainly the white papers are longer form content, and then the books. Twitter, is sort of it's become more of a distraction for me, and I don't want to say that in a completely negative way, but more of a kind of time suck. But it's a little bit kind of schizophrenic, being able to think in terms of 140 characters in a lot of ways. I think there's probably some innovative ideas on there on Twitter curation that haven't really popped up yet that I would like to see. But the blog for sure has been the best outlet for us.
Okay, we have time for one last question. This is a good one. What type of regulatory hurdles do you face with the book? Do you have a compliance review of the books, etc.?
Yeah, so the book, most of our writing on the blog and our books and white papers don't mention products. They are simply research pieces. They tend to be academic, slightly boring in many cases. So we want to be very on the up and up. Almost never will you see anywhere on the blog or white papers mention or us trying to promote or sell any of the funds. We may have mentioned that we do have them or are launching them at some point, but I try to keep a very Chinese wall in between just promoting ideas and research. And in many cases, we say, hey, look, you can go do this on your own. Shareholder yield, say, hey, look, here's how you do it. You can go do it on your own. Same thing with many of our other models. But, yes, we still ran it through FINRA and just got their opinion. We weren't treating it as a marketing piece or advertising piece, so we didn't feel like we had to run it through them. But if you were going to write something, and like say for example, Wisdom Tree was doing a piece on their ETFs, or State Street, or one of these shops, mutual funds, you absolutely better be running it through FINRA if you're talking about the product or performance. But we never mentioned the ETF in the book, and that was a very intentional thing to do, because we want to be able to, at the end of the day, our writing in many cases is to kind of empower the investor, and I'm agnostic as to whether you go and do a lot of this stuff on your own or hire us to do it. But most of our writing is about sharing ideas, and if we had something uber proprietary, we simply wouldn't publish it, or wouldn't publish it in a format that that would be public. So but yes, we still ran it through the authorities just to make sure it was going to be okay.
Great. So your books are up for sale on Amazon. So if you want to check out the Ivy Portfolio or Shareholder Yield, you'll find those there. I have listed here on the slide in front of everybody a couple other places. Where do you want to send people to learn more about what you do?
Our blog is kind of the home, MebaneFaber.com. Our new Cambria website, CambriaFunds.com, that's the ETF site. There'll be more content on there eventually. We moved the blog completely over there. It'll be more formal, of course. We have a service called the Idea Farm that I send out basically top 2 or 3, usually institutional research pieces per week that come across my desk to people. It's something that I think is super useful and gets people a lot of research they may never have seen. Those are the best ways, and of course on Twitter, Meb Faber too.
Great. Before we go, Meb, first I want to thank you for opening the kimono and sharing so much about your process. I know you like to pay it forward. I know I certainly learned from this event, so thank you.
Yeah, absolutely. Any of your readers, you get any extra questions, feel free to email me later. I'm happy to share, as well as I'm happy to send you a free book too.
Awesome. And just before we go, I just want to tell everybody, I've actually worked with dozens of authors who have gotten published. I recently launched a short course encapsulating a lot of the experiences that I had publishing my book and working with other people. It's called PublishingTearSheet.com. It's specifically for finance people. So a lot of the things Meb talked about in terms of strategizing the purpose of your book, or using as an ancillary revenue model, or are you looking at it sort of just as an end all? We address issues with that. I take you through sort of 11 different lessons. I include also some of the stuff that was instrumental in me landing a contract with I published through Jay Wiley as well. I have my pitch book, and I actually include in the course itself a list of 100 of the top finance literary agents. So I did the research. I found out who the top people were. I include that as well. I do think it increases your chances to land a publisher and get published. So if you're interested in something like that, if you find it helpful, check out PublishingTearSheet.com. I'd like to thank everybody for joining us. We had a very nice turnout. And again, Ned, thank you so much for joining us. And this concludes the webinar.
All
the best.
Thanks.